Welcome to this explainer. Today, we're going to completely demystify one of the absolute most important and honestly least understood institutions in the entire world. Have you ever wondered why prices go up at the grocery store, why mortgage rates suddenly change, or why the stock market just tanks after a totally routine press conference? Well, you are in the exact right place. We're going to build your understanding of the financial system from the ground up with absolutely zero confusing jargon. By the end of our time together, I promise you're going to see the global economy in a completely different light. So let's kick things off with a really simple question. Who do you think actually has more influence over our economy? Is it the largest, wealthiest company in the country? Or is it the central bank? Take a quick second to really think about that one. Now, a lot of people naturally assume the answer has to be a giant corporation, right? I mean, big tech companies and global retailers employ hundreds of thousands of people and rake in hundreds of billions of dollars. They're massive. But economists, they focus on an entirely different institution. It's the central bank. Believe it or not, a single decision made by a central bank can simultaneously shift borrowing costs, inflation, business investments, the housing market, employment, and overall economic growth on a global scale. Because central banks sit at the very center of our modern monetary system, they are literally the true invisible giants of the economy. Here is our agenda for today. First, we'll look at the bank for banks. Second, the four pillars of stability. Third, we'll bust the money printing myth. And finally, we'll talk about why it matters to you. All right, let's jump straight into section 1, the bank for banks. We're going to understand the foundation of the financial system. Simply put, a central bank is the institution responsible for managing a country's monetary system and helping to maintain economic stability. Most countries have one. In the United States, we call it the Federal Reserve. Over in Europe, it's the European Central Bank. You've also got the Bank of England, the Reserve Bank of India, the Bank of Japan, the list goes on. And while they might operate just a little bit differently depending on where you are, they all share the exact same goals: to maintain stable prices, support economic growth, and most importantly, preserve your confidence in the financial system. Historically speaking, before these institutions were around, financial panics spread like wildfire and bank failures were incredibly common. Central banks were created specifically to lay down a solid foundation of stability. Now, here's something a lot of beginners find really surprising. A central bank is absolutely nothing like that local bank down your street. You cannot walk into the Federal Reserve and open a checking account. You're not getting a central bank debit card, and they for sure aren't giving you a mortgage. Commercial banks are the ones that serve everyday consumers and businesses. Central banks, on the other hand, serve the financial system itself. They are, quite literally, the bank for the banks. Moving right along to section 2, four pillars of stability. This is the engine room of the economy. To really understand their importance, we can break their huge responsibilities down into four major pillars. First up is managing inflation, making sure prices don't spiral completely out of control. Second is influencing interest rates, which is basically them setting the price of money itself. Third, managing the money supply, so how much currency is actually circulating out there in the world. And fourth, maintaining overall financial stability, ensuring the whole system doesn't just collapse during a crisis. Let's look at how these pillars actually play out in real life. Let's walk through the real-world mechanics here. Imagine inflation suddenly jumps from a totally normal 2% all the way up to 8%. Prices are rising super fast because consumers are out there spending heavily, and demand is completely outpacing supply. The central bank gets concerned, right? So they step in and they raise interest rates. Suddenly, borrowing money becomes much more expensive. Mortgage rates shoot up, so buying a house costs a lot more. Business loans get pricey. And because it costs so much more to borrow, consumer spending and business investments naturally start to slow down. As all that demand gradually cools off, the pressure on prices drops, and inflation finally begins moving lower. It's an economic chain reaction. But what happens if the economy faces a sudden, massive crisis? Look, modern economies run entirely on confidence. We trust our banks to keep our deposits safe. If that confidence vanishes, you get a full-blown panic, and that is exactly where the fourth pillar comes in. Central banks act as the ultimate lender of last resort. During a crisis, they provide what's called liquidity, which really just means immediate access to cash to banking institutions that are facing temporary trouble. Now, it's really important to know that the central bank's goal here is not to rescue every failing business or bail out bad decisions. Their goal is simply to prevent a small, localized problem from spreading and burning down the entire financial system. That brings us to section 3, the money printing myth. We're going to talk about understanding limits and economic reality. I hear this question all the time, and honestly, at first glance, it sounds completely logical. If money is what helps people buy things, and the central bank controls the money, why not just create more of it? Why not print enough to make absolutely everyone wealthy and solve all of our economic problems at once? It's a fascinating thought, and it's a great most people don't realize moment. Well, here is the harsh reality check. The economy doesn't magically become richer just because there are more pieces of paper or more digital currency units floating around. True wealth is measured by the actual amount of real goods and services available to us: the cars, the food, the healthcare, the software we use. If a central bank prints money much faster than the economy can actually produce those physical goods and services, the result is incredibly simple. Prices rise. You get massive inflation. Having more money chasing the exact same amount of stuff just makes that stuff way more expensive. Central banks simply cannot print their way out of reality. And that brings us to another huge misconception. People often assume central banks have perfect control over the economy. They really don't. Economies are these incredibly complex webs of millions of households and businesses making billions of individual decisions every single day. Economics is definitely not an exact science, so central banks don't have direct absolute control. They can't just mandate that you buy a house or force a business to hire 10 new people. Instead, what they have is influence. By tweaking interest rates, they shift our incentives. They make it slightly more attractive to save your money or slightly more attractive to borrow it. And they rely on those little adjusted incentives to carefully steer the massive ship that is the global economy. Let's head into our final section, Section 4, Why It Matters to You. This is where we connect high-level macroeconomic policy straight to your wallet. So let's map out exactly how these massive policies actually hit your wallet on a day-to-day basis. When the central bank raises interest rates to fight off inflation, it really hurts if you're trying to borrow money. Mortgages cost more, which makes it a lot harder to buy a home. But on the flip side, if you have money just sitting in a savings account, you're suddenly going to earn more interest on it. Conversely, if the economy dips into a recession and the central bank lowers interest rates, borrowing becomes cheap again. That encourages businesses to take out loans, expand their operations, and hire more people, which is fantastic if you're out there looking for a job. Your personal financial reality is constantly being shaped by these big moves. And honestly, this is exactly why financial markets completely obsess over every single word a central bank leader says. If you're an investor, you know full well that interest rates dictate corporate profits, borrowing costs, and consumer spending. So the very moment a central bank announces a policy change, or hey, even just hints at one, expectations about the future change instantly. The actual economy might take months to physically slow down or speed up, but the stock market, it's going to reprice everything immediately based on those brand new expectations. So you now understand the foundation. You know what a central bank actually is. You know the 4 pillars of stability they maintain, why they can't just print unlimited wealth for everyone, and how their influence directly impacts your savings, your loans, and even your job prospects. They truly are the invisible giant of the economy. In our next explainer, we're going to pop open the hood and look at the specific toolkits central banks use to actually achieve these goals, monetary policy. But until then, I want to leave you with this one provocative thought to chew on. If central banks hold this much influence over the cost of everything we buy and the value of everything we save, who truly controls the value of the money in your pocket today? Thanks for learning with me, and I will see you in the next explainer.